We are going to start. If we can get Mr. Kupiak to come to order. Thank you. Thank you. Ladies and gentlemen, good evening, and thank you for being with us. I'm Alex Pollock of AEI, and it's my pleasure to welcome you to our book event and presentation and discussion of Greg Ip's highly interesting new book, Foolproof: Why Safety Can Be Dangerous and How Danger Can Make Us Safe. Here is the book. It's for sale next door, so we hope if you haven't already, you'll all buy a copy before the evening is out here. To begin with, let's think about bubbles and crises. Financial bubbles and their ensuing collapses have occurred in many countries and many times in history. They always end painfully, yet they keep happening. As the prophet said, slightly amended, there is nothing new under the financial sun. The cycle that hath been is that which shall be. Why is this? At the beginning of Foolproof, Greg interestingly discusses the theory of Hyman Minsky, who is a good friend of mine, that periods of sustained financial success lead to first what he called financial fragility and then to crisis. In slogan form, that's stability creates instability. Alternately, as Greg writes, safe assets morph over time, and that which was considered to be, by everybody, to be safe, perhaps because it was considered by everybody to be safe, in fact, becomes very risky and in the end imposes huge losses. Or, as the Roman historian Velleius Paterculus wrote about 30 AD, the most common beginning of disaster was a sense of security. Now, Minsky's notion is that the crises are endogenous. That is, they arise from the internal dynamics of financial actions, not from external blows or so-called shocks. Greg's book provocatively observes these dynamics not only in finance, but in many other fields, such as forest fires, automobile travel, the use of antibiotics, and economic growth in general. It seems to me to understand the complex situation correctly, as it applies to finance in particular, we must understand that the financial system, the system in this case, includes, in addition to the private actors, all the parts of the government, all the regulators, all the central banks, and all the politicians. They are all part of the same interacting complex system. And as the book explores at length, the efforts of government actions as part of this system, intended to make things safer and perhaps appearing to make things safer for a while, maybe even a long time, may in fact create new risks and subsequent disasters. Moreover, Greg ponders whether the same factors which create innovation and growth and make ordinary people so much better off as they are under modernization, whether these same factors are necessarily accompanied by cyclical booms and busts, as indeed they may be. Thus, he speculates periodic crisis is the necessary price we pay for economic growth. And this is because the taking of risk creates both growth and crises. Greg's book goes on to consider what we or anybody can do to cope with endlessly adapting complex systems of the kind he so interestingly discusses, and how can they be coped with in a balanced, reasonable way. That's a challenge, to say the least, and we'll hear more about it, I'm sure. Greg is going to discuss Foolproof for about 25 minutes. After his presentation, I will introduce our two outstanding discussants, We'll comment for about 10 minutes each. We'll give the panel a chance to exchange ideas, and we'll open the floor to your questions, and we'll adjourn promptly at 6:15, at which time you're all invited to a reception next door, which will also, you'll also have a chance to have your book autographed by the author. So let me introduce our author this evening. Greg Ip is the chief economics commentator of the Wall Street Journal. He enlightens its readers with discussions of U.S. and global economic developments in his Capital Account column and on real-time economics, the journal's economics blog. Previously, Greg was U.S. economics editor for The Economist and a reporter for the Wall Street Journal covering financial markets and monetary and fiscal policy. He's also the author of the Little Book of Economics, How the Economy Works in the Real World, and has won or shared in several journalism prizes. Greg, we're delighted to welcome you to the AEI podium to present Foolproof.
I get this started this way. Thanks very much, Alex, and it's thank you very much for having me, and it's a pleasure to be here. I've come to many events at AEI, and it's a real honor to actually be to have one for myself. And you did an excellent job of summarizing the book. This morning, I was writing a piece for the Wall Street Journal on the convulsions we're seeing in the financial markets now as the Fed prepares to. As the Fed ended its 7 years of ultra-easy monetary policy. And I was remembering a lot of the things that I had come across researching this book and in my own career and looking for those spots in the economy where things that people thought were safe, whether it was exchange-traded funds that held corporate bonds or whatever, no longer are. And it was a reminder to me that there's always stresses building out there that we have probably set aside or forgotten about just because it's been so long since we experienced them. A little bit of personal history about why I wrote this book. In 2006, 2007, all around us we could see the signs of excesses. We were talking about walls of money rushing into private equity, rushing into venture capital. We were all wondering how this was all going to end. We had written about housing bubbles and so forth. One thing I did not write about was collateralized debt obligations or AAA-rated sub-tranches of subprime mortgage-backed securities. They were just floating away under my radar somewhere, and probably at some point somebody had told me these are ultra-safe, super senior securities, they're not a problem, and I probably believed them. And I, saw that the Federal Reserve had done such a marvelous job. Every time I thought we were going to have a problem, the Fed did a great job of getting us out of it. And I couldn't conceive of a set of circumstances which would overwhelm all the defenses that we had erected over the last 25 years. And so, looking back at the wreckage, after I sort of embarked on this mission to find out what and I think many people who I think had the same cognitive failure, what did we do wrong? And this book is kind of the result. And my story actually begins about 100 years ago in progressive era when a couple of forces came together, I think, to create the idea that the government could do a lot to make our environment, both our economic and our ecological environment, safer. There was a force of progressivism, which I describe as both a backlash against the concentration of economic power in the trusts and just a few hands in the Gilded Age, and the knowledge and scientific revolution. This idea that we could use knowledge to actually make ourselves better. The Nobel Prizes were created around this point. Many professional associations, like the American Economic Association, were also created around this point. In 1907, there was the worst financial panic of the era occurred on Wall Street, and that event led to the creation of the Federal Reserve. Robert Latham Owen was a senator who had actually owned a small bank in the West, in Oklahoma, that almost failed during the Panic of 1873, and he had always been a campaigner for the creation of a central bank, and he co-sponsored the legislation that created the Federal Reserve, basically saying, the quote you see here, "It is the duty of the United States to provide a means by which the periodic panics which shake the Republic and do it enormous injury shall be stopped." And so in 1913, Woodrow Wilson, one of the two great progressive presidents, along with Theodore Roosevelt, signs the Federal Reserve Act. Now, a lot of people who have covered finance are very familiar with this story, but they're probably less familiar with the story that something similar was happening in the environmental area. There were very severe fires that broke out in the western United States in 1910, destroyed large swaths of Idaho, Wyoming, and Montana. The U.S. Forest Service was only a few years old at that time and didn't really have a lot to do. But the first chief of the Forest Service, Gifford Pinchot, who was a confidant of Theodore Roosevelt, discovered a new mission for the Forest Service in these events. It was to put out fire. And it was interesting because at this point, Theodore Roosevelt was constantly butting heads with the logging industry. Roosevelt was was an environmentalist who wanted to set aside more land for parks, and the industry saw this as a threat to their source of raw material. But they agreed on one thing, which was that wildfire was a terrible thing because it meant that the forests were not available either for industry or for public consumption. And so they agreed on this one thing, and Pinchot essentially personified this view that forest fire was a terrible waste and had to be stopped. And so over the next 20 years, the Forest Service became this highly regimented and almost militarized service in their approach to fire. And in the 1930s, this was codified as the 10 a.m. rule, which was that by 10 a.m., the day after a fire was detected, it had to be under control. The two posters you see here, I think, I really, really liked it when I came across these pictures because I think they beautifully illustrate the philosophy of the time. On the left is a poster that members of the Federal Reserve System could put in their windows and essentially portrays the Fed as the Hoover Dam, able to supply the liquidity necessary to save the economy from the threat of crisis. On the right is an early poster from the Smokey Bear campaign. Smokey Bear came along in the 30s and 40s, and nowadays he's kind of seen as this guy, well, let's just protect the forests for the good of themselves. But actually, at the creation of the campaign, it had a very strong underlying economic message. Burning forests is a waste. It means that we don't have material to build houses and so forth. In the 1940s, it was seen as like, the evil Axis powers may set fire to our forests to damage our war effort. And so putting out fires wasn't just about good ecology. It was an important economic duty of ourselves. So was it successful? Were these early efforts to control our environment successful? Well, they were in a sense because at least from the 1930s onwards, we didn't have any severe financial crises. But as you know, we eventually did again. We had one just a few years ago from 2007 to 2009. And we still have wildfires. And in fact, after a long period of docility, wildfires around the year 2000 started getting bigger and bigger. And in both cases, this was actually not a sign of the failure of the Fed or the Forest Service, but of their success. In other words, the Fed, in my view, had very successfully prevented many of the traditional forces of instability. And this, as Alex summarized in his introductory remarks, led them into the Minskyite model of that stability itself breeding instability. Now, in the case of forest fires, it's been more complicated because the climate has been getting warmer and drier, and that is associated with with more burning. But a lot of the burning is also the result of the fact that fire suppression over the last century has left a lot of forests unburned. And so what you're seeing are these like mega fires, which are in essence consuming fuel that's accumulated over hundreds of years. In my book, I sort of summarize the two approaches to managing our environment as the engineering and the ecological tradition. Engineers, I use the word engineer not in the sense of somebody who's actually studied engineering, although they often do think that way, but in the broader sense that it's somebody who takes knowledge and uses it to make our surroundings better. It basically reflects a fundamental problem-solving approach to the world, and no matter what the problem is, there is a methodology that with enough willpower and good intention, we can fix it. Ecologists are much more suspicious of efforts to tamper with the surroundings, and they basically see unintended consequences everywhere and always worry that intervention will ultimately make it worse. And not to ruin the ending or anything like that, but I do not, in the end of my book, come down either as one or the other, and because I see that there are strengths and weaknesses in both sides. My book is almost an anthropological exploration of these two schools of thoughts. But I will say that I myself went through a little bit of a life cycle of my own. I think I started life as kind of an engineer, kind of an Austrian Hayekian who was very suspicious of the Fed's intervention. And then after 25 years of seeing the Fed actually succeed, I kind of became an engineer and became ultimately very trusting of it. And I think over the last 7 or 8 years, I sort of like did a partial pivot back. Now I'm somewhere in between. The first slide here is a slide that I often show when I'm talking about the economy, and it's basically in one chart the story that I think of the Great Moderation. The gray lines are recessions, and we used to have recessions 2 or 3 times per decade, But starting in 1982, after Volcker slayed the Great Inflation, we actually were blessed with a long period of calm growth, just 2 recessions, which at the time were the mildest in the post-war period. Inflation that was low and continued to get lower, and unemployment that did occasionally rise, but each time it rose to lower levels than before. And this became known as the Great Moderation. We did have financial crises, but they never seemed to affect the real economy. The 1987 stock market crash, the near failure of long-term capital management in 1998. These were traumatic events for folks in the markets, but they didn't have any effect on the economy. And this kind of convinced us that the Fed really had figured things out. It really had, solved the business cycle. Well, the very natural response, if the economy seems calmer and less volatile, is that you will take on more risk, although it doesn't seem like more risk at the time. For example, if you're going to buy a house, one of the risks of buying a house is always that the house value will decline because the economy goes into recession. But if there's fewer recessions, why not do it? Things like the junk bond market was itself is kind of a product of the Great Moderation, because if recessions were less likely, then the events that would drive a highly leveraged company into bankruptcy were also less likely. So it was okay to take on more debt. So this was, I sometimes say that people think that these things created a false sense of security, but it really wasn't false, because you really were secure. The Great Moderation really did happen. The other thing that happened was there's also a narrative that, every time we bailed out the banks or something like that, we just gave them the incentive to do it all over again. And my story is somewhat more subtle, because, for example, in the 1980s, and Alex, you know the story, I think possibly better than anybody else, the 1980s was like one banking crisis after another. And in those days, when we said banking crisis, we really meant banks, by which I meant depositories. In 1982, all of the money center banks were on the brink of insolvency because of the loans they had made to Latin America. Then in 1984, we cycled through this where continental Illinois, which had expanded rapidly by buying other banks, was on the verge of failure. And Paul Volcker intervened and basically browbeat the FDIC into actually buying that bank so that it would not fail, not because he wanted to do for Continental Illinois a favor, but because there were so many other banks that, like Continental, had funded itself with uninsured deposits, and he was afraid of a run on the entire banking system. And it was at that time that the word "too big to fail" first entered our lexicon. But Volcker didn't just leave it at that. Volcker actually initiated the process of, for the first time, requiring banks to hold more capital. And Alan Greenspan picked up where Volcker left off. So we had the very first actual statutory capital requirements for banks. These were the Basel Accords. And if you remember the 1990-91 recession and the fact that the recovery was so sluggish, this was routinely blamed on the fact that banks were being forced to boost their capital requirements, and therefore they couldn't lend. So banks actually, by 2007, the depositories had more capital than they ever had before. But here's the thing. As we made the banks safer, we made banking less profitable. And the natural reaction, therefore, was for lending to migrate to where it could make more money. And this gave rise to the flourishing of what we now call the shadow banking system, which involved things like finance companies like Countrywide Financial or New Century. They would originate loans, and then they would package these loans into mortgage-backed securities with the help of the Bear Stearns and Lehman Brothers of the world. And those securities would then be owned by pension funds or insurance companies or hedge funds or foreign central banks. And so what started out as an attempt to make the financial system safer caused risk to migrate someplace else and end up creating a far more fragile financial system. Now I'm going to segue a little bit to the environmental world, because there's something similar going on. We all see these storms going on around us. And in fact, as you'll see from my chart here, the number of natural disasters that cost more than $1 billion has been going up. And so a lot of debate has been going on about what's the cause of this. And a lot of folks say, well, it must be global warming. And now, first of all, I believe in global warming, and I do believe that man-made activity is contributing to the rise in carbon dioxide, and it must be dealt with. However, these trends cannot explain the rise in storm damage. In fact, when you think about Hurricane Sandy, for example, which was the second most costly storm in American history, what was interesting about Sandy was that it was almost completely predicted by people who study catastrophes for a living. Insurance experts had said New York City sits right in a spot tailor-made for a North Atlantic hurricane to interact with a nor'easter and create a very broad system that can be quite damaging. And in fact, it happens approximately twice per century. It happened in 1938. But between 1938 and 2012, a couple things happened. First of all, New York became a lot wealthier. We built a couple of airports. We built in new highways, tunnels, and so on. A lot of very cheap little homes turned into million-dollar mansions. Essentially, we put a lot more infrastructure in that place. The other thing that happened is people forgot that hurricanes regularly hit New York. And so when Sandy came along, there was virtually nobody alive who had any memory of the fact that this was actually a twice per century occurrence. Take a look at this slide. This shows the value of structures in the 100-year flood zone of New York City. And this is in constant dollars. And you can see that line heading up in a straight line since the 1920s. And this is what I think is a really interesting picture. The picture here is, if you look at that red line, if you can make it out, that is actually the outline of Lower Manhattan in 1609. Everything else is landfill. Now, the blue area is the Hurricane Sandy storm surge area. Those areas were flooded during Sandy. Notice how closely they match each other. As I like to say, for the last 4 centuries, we've been trying to take land back from the sea, and in Hurricane Sandy, the sea asked for it back. And so all I'm trying to say here is that if you want to know why, where you're going to get a lot of storm damage, look where we've put valuable infrastructure next to the water, and you'll have your answer. Turning to forests for a minute, this was one of the most interesting things I discovered while I was working on my book. It turns out that we can recreate the history of forest fire in the West even long before Europeans came. And that involves, first of all, either looking at trees that are 2,000 years old, studying studying the cross-section of the tree trunks, and looking at the rings, and you can actually see the scars of forest fires, and you can determine when those fires occurred. The other thing you can do is that forest fires throw an enormous amount of charcoal in the air, which falls into lakes, settles to the bottom. And then if you do a core sample of the lake bottom, it's almost like a time capsule. So forest scientists across the United States have been putting together samples and have actually been able to recreate a 2,000-year history of forest fire in the western United States. And so the black line is what you see as actual burning of forests. And you can see that we go through these very long cycles of hot, dry weather when there's more burning and less dry weather when there's less. Now, the dotted line you see is what was a predicted level of burning given what we know about the climate in those times. And again, because of scientists' work on things like glaciers and so forth, we can recreate what the climate looked like for the last 2,000 years. What I find interesting is in the last century, as the climate has gotten hotter and drier, that dotted line, which is the predicted amount of burning, goes up. But the actual amount of burning, up until about 15 years ago, was going down. And the reason why was we were suppressing fires. And so what forest scientists say is that we created a fire deficit, that nature was trying to reassert the normal balance between fire and between forest and fire, and humanity was interfering with the process by suppressing those fires. Now we're seeing megafires coming back, and that is in part because the amount of it's almost like the environment is trying to assert the level of fire that is appropriate given how hot and dry the forests now are. Turning to the more quotidian aspect of my story, Sam Peltzman is an economist at the University of Chicago. I think he's a well-known individual. He's often a speaker at AEI. I think he's been honored here. And he's always been a bit of an iconoclast. He told me that when he was 8 years old, everybody on the street in Bensonhurst where he lived was for Truman, and he was the only one who was for Dewey. Actually, sorry, some on the street were for Henry Wallace, apparently. Anyway, he says he was the only one who was for Dewey. In any case, he continued to be an iconoclast, goes to the University of Chicago, studied under George Stigler, so he writes a lot of stuff that's very skeptical of regulation. In the 1960s, partly because of Ralph Nader's book, Unsafe at Any Speed, the federal government began to assert its role in the safety in making automobiles safer, and seatbelts become mandatory in the manufacture of automobiles, along with a lot of other things. And by the 70s, the first mandatory seatbelt laws are being introduced. Well, Sam basically wanted to figure out whether the seatbelt laws were actually changing how people drove. So he studied the effect of introduction of seatbelts on accident statistics, and he concluded that yes, driver deaths went down, but pedestrian deaths went up. And he inferred from that seatbelts were making people drive faster and therefore having more accidents that killed pedestrians. Well, this was actually very interesting, but as you can imagine, it was very controversial, and it caused a lot of other people to study the question intensively. And it turns out to be a very difficult question to study because you really need, for an answer, you really need to be able to observe how a driver behaves differently when everything is exactly the same except for the fact that he's a seatbelt. Now, it's actually hard to conduct experiments where you ask people to drive faster and put them in a seatbelt. So you actually have to study large bodies of data and try and control for these factors. And what we've discovered is that the most thorough research does actually find that the number of deaths go down. We do not find an increase in pedestrian deaths. However, we do find that occupant deaths go down less than predicted when seatbelts were introduced. However, when you do the same research with other safety devices like anti-lock brakes, you actually do find that there is no improvement. And it turns out that anti-lock brakes do apparently cause people to drive differently and in different ways. For example, one study found that people with anti-lock brakes seemed to brake harder. They had fewer front-end collisions and more rear-end collisions. We also know from research that driver's education doesn't actually reduce accidents by young drivers. It turns out that young drivers are so risky when they drive and so convinced of their immortality that even sending them to driver's ed doesn't seem to change the way they drive. And in fact, in some circumstances, it leads to more accidents because it enables these kids to get their driver's licenses earlier. And there's one study that found that in Norway that found that kids who had like skid-related training had more wipeouts. So all the way of saying is that when you study things carefully, you can't. I didn't come away with any sort of like sweeping story about what every time you regulate it makes it worse. What I concluded was that you always have to study it differently. But the upshot of the automobile example was that the theory about why seatbelts don't have a full offset, but anti-lock brakes do, is that seatbelts don't change the driving task. Nowadays, virtually nobody even thinks about the fact that they're wearing a seatbelt, so they don't really drive differently because they don't feel they can do things differently. But if you give them anti-lock brakes or studded snow tires or training in how to drive more safely, they feel they can drive better in conditions that they otherwise could not. And so it changes the driving task. And I feel that the same thing is true of financial derivatives. Financial derivatives are meant to reduce the risk of a given position. I want to make this loan, I want to buy this security, but I want to limit certain types of the risk involved in that, so I purchase a derivative. I put on a hedge. And that hedge allows you to do things that you otherwise would not do. And in that case, it changes your behavior. And the same with football helmets. In the 1940s, when hard helmets started replacing leather helmets, coaches learned that their players could now spear each other because their head was protected. And this was a more effective way for a defending player to bring down an offensive player rather than just using their arms. So the football helmet changed the way they behave. But in the process, it also led to injuries that they didn't see before. Quadriplegics and broken neck injuries started to go up. Even after the NCAA and the NFL outlawed spearing, you still continue to have concussion problems, which are a consequence of the force with which players in helmets hit each other. Another way that risk sort of fools is what I call the fallacy of composition. Now, we're all familiar with this basic idea. If you stand up in the movie theater, you see better. If everybody stands up, nobody sees better, and everybody's feet are more tired. Well, that takes place at a larger level with many things that we think are make us safer. One example I just gave you was with anti-lock brakes, how maybe you're safer because you stop harder, but the guy behind you is less safe because he hits you. And so we're beginning to see something similar, by the way, with driverless cars, which apparently are so sensitive of braking at stoplights and so on, is that they're involved in a lot of rear-end collisions. And I believe that derivatives do the same thing. In fact, there's a variety of research which has constructed models. Let's say that Alex, Paul, and I each lend each other $100, okay? So all of us now have a $100 claim and a $100 asset. So in theory, on net, everything's the same, but we've just created gross positions among the three of us. We've created $300 of assets and liabilities that didn't exist before. And it's the same with derivatives. If every bank lays off risk over another bank, in the end, the aggregate amount of risk in the system, not only does it not go down, it may have gone up because every individual institution feels that they have actually hedged themselves. But in reality, what they've done is that it's like somebody on the Titanic buying insurance on the Titanic from somebody else on the Titanic. No system can insure itself against catastrophe. This is what happened in 2008. All these banks were buying insurance against the subprime mortgages they own going bad from AIG. Worked fine until it turned out that somebody had the insurance policies all were triggered, and AIG did not have the ability to survive the event that it was insuring against. Another example of fallacy of composition is antibiotics. They were discovered in the 1940s. They really were a miracle drug, and very soon things like tuberculosis and other diseases that had long sort of resisted our attempts to control them were being solved. But literally within years of the introduction of antibiotics, we're starting to see resistance appear. And in fact, Sanford Fleming, whose discovery. Alexander Fleming, Alexander Fleming, whose insight discovered antibiotics, had predicted this would happen. Only it happened much faster than he predicted because of the innovative ways bacteria mutate and actually take on the resistant properties of other bacteria. And this chart kind of tells you in one picture, I think, the story. In countries where antibiotics are used more, there's much more prevalence of antibiotic resistance. And you now have diseases like MRSA, which is essentially a man-made scourge, which kills thousands of people a year and makes thousands of others very, very sick. And there are people out there who believe the age of antibiotics is drawing to an end. I'm not personally this pessimistic, but it's not my specialty. But they believe there may be a time when antibiotics have largely lost their effectiveness. Okay. So what should we do? First of all, it's true that safety makes us dangerous, but danger also makes us safe. The awareness of fear actually makes us behave more safely. One of the reasons aviation accidents have fallen so much is because people are often afraid to fly, and the fact that we in the media basically blow every accident out of proportion actually contributes. So we are willing to tolerate enormous expense and inconvenience so that aviation is safe. Space is important. The Dutch have a saying about levees, for example. The only two types of levees are those that have failed and those that will fail. So they have actually discovered that the safer way to deal with floods is to actually get rid of the levees and simply use the floodplain for green space. And then they've actually demolished some of their levees, and they're creating areas so that the floodplain can flood in unpopulated areas, protecting cities further down. Do your homework. As I was saying throughout this presentation, if you actually research the question, whether it's hurricane damage or football helmets or anti-lock brakes, you can figure out which ways to make us safe work and which do not. Motorcycle helmets apparently do not have an offsetting effect. They make us safer. Bicycle helmet laws, though, apparently do cause people to bicycle less, so they don't get the benefits of bicycling. And the final point that I want to leave you with is that we should not seek to eliminate all disasters and crises altogether, because as Alex was saying in the introductory remark, crises come from risk-taking, and risk-taking makes us richer. This is a chart that I find very interesting. It looks at the growth of per capita GDP in Thailand and India over the period from 1980 to 2002. Thailand had a much more open and liberalized financial system and much more openness to foreign investment, and India pursued a more repressive government-directed model. Thailand had a catastrophic financial crisis in 1997, and in spite of that, they ended up richer than India did over that very long period. I'm not saying we should want crises or that we should look for crises. I'm not saying crises are good things, but sometimes crises are the price you pay for a system that encourages risk-taking, and I don't want to live in a world without risk-taking. That's all.
Thanks, Greg, very much. We'll ask our discussants to join us, please. We're lucky to have two very well-informed and knowledgeable commentators. First will be Paul Kupiec, my colleague and a resident scholar here at AEI. Paul is an expert in the regulation of banks and financial markets, including issues of systemic risk and the effects of financial regulation on the U.S. economy. He's managing his risk by getting his clicker. Yes. Just a second. Previously, Paul was director of the Center for Financial Research at the Federal Deposit Insurance Corporation and chairman of the research task force of the Basel Committee, and has also been with the International Monetary Fund, Freddie Mac, J.P. Morgan, and the Federal Reserve Board, and he is well placed indeed to consider the regulatory conundrums posed by tonight's book. Our second commentator will be Frank Medina, who is senior counsel and director of research at Better Markets. Frank was previously deputy chief counsel for the House Financial Services Committee, where he drafted legislation and analyzed issues including financial stability, systemic risk, and financial crises. He's also been with the Securities and Exchange Commission, Citigroup, and the law firm of Wilmer and Cutler. Frank's work represents an uncommon ability to blend philosophical perspectives with financial paradoxes, just like Greg's book does. With that, Paul, over to you.
Thank you very much. I'm going to talk from over here so I can manage this slideshow. So Foolproof is a great book. Let me start with a little picture there. And if you don't recognize him, that's the main character in Mad Magazine, named Alfred E. Newman. And his motto is, "What, me worry?" So I thought that was a good way to start. So he's jumping out of the airplane, and his cord obviously doesn't work, but he doesn't look too worried about it.
Yet.
Yeah. So Greg tells us an interesting story where the best-intentioned government policies fail because people adapt and behave in ways that ultimately undermine the policy. Levees and dikes are built to reduce the catastrophic flood damage, but they don't. People attract and build in the safety zones, and the next flood causes even larger losses. The Great Moderation, the economic stability convinced a whole generation of consumers that leverage is really good. The economy was stable enough that they could afford to lever up. But when consumers actually borrowed so much that their balance sheets became unsustainable, the Fed's moderation tools no longer worked, and so the Great Moderation ended. The euro removed the financial constraints on the least fiscally responsible countries, and it may come as relatively little surprise that these spendthrift countries actually went for broke, quite literally. They borrowed and spent their way into a crisis. I should click, right? The moral of the story, policies imposed to produce safety often end up failing to improve safety. Now we're going to start with a test because Greg told you pretty much what's in his book. Alex has covered it, so let's start with a test and we'll see if we're any better at the end. So the question in the test is, how should the government react after a crisis or new data reveals that prior policies and regulation do not improve safety? The first choice is, should they provide government assistance to cover the losses suffered by those injured because the safety regulations didn't work? In other words, cheap loans or grants to rebuild the homes around the levee? Or is the answer impose new comprehensive regulations to stop risky practices and show the public that the risk has been removed? For example, repair, reinforce, and make the levees higher so they can stop a bigger flood. Or should we prosecute people that legally circumvented the regulations for profit? And maybe we can scapegoat them for the policy failure. Maybe prosecute the home builders for building around the dike, or maybe the homeowners who bought the home, or maybe the bankers who lent them the money. Or maybe the answer is all of the above, or maybe the answer is none of the above. Well, our government selected all of the above. After the last crisis, what did we do? Well, government actually increased its borrowing, essentially to replace the drop in private debt. And it also, it had disaster relief in the form of TARP and Fannie and Freddie bailouts. It prosecuted the institutions that engaged in the activity that were alleged to cause the crisis, and it passed laws that required thousands of pages of new tough and complex financial regulations to make sure the system would be safe or fail safe. And it hired thousands of new government employees to write and enforce the rules. And just to keep that's my mo, is keeping an eye on those two risky big cat financiers. Mm-hmm. So financial stability after the Dodd-Frank Act. It really, if you read the Dodd-Frank Act, it relies on Federal Reserve Board sort of what I call superhero powers. The Federal Reserve Board is supposed to provide heightened supervision and regulation to keep the systemically important financial institutions, or SIFIs, from failing. They're supposed to have macroprudential powers and exercise them to prevent the next financial bubble. They have a new role as a national and an international, actually, insurance regulator. They have the power to now write prompt corrective action rules for bank holding companies and non-bank systemically important financial institutions like MetLife. Now, what does the board know about running MetLife? Power to break up the SIFIs if they don't produce an acceptable living will, and we can talk about that. So my little thing to help you remember this is that is an unknown Federal Reserve official testing out his new macroprudential powers. There, I found that one for you. And just to keep this in mind, here's a shot of Janet Yellen, who's controlling the leveraged loan market with her new powers, and that's Stanley Fischer coming in to save us from shadow banks, and that one is Dan Turillo there as Spider-Man, who's considering his new options to regulate the large SIFIs. So that's, of course, all in good fun. But any criticism of the book, well, not criticism really, but if I could change one thing, I would encourage Greg to be more critical of financial regulators and more skeptical about the settled science. So the regulators investigated before the crisis many trends I was there, many trends in industry practices that contributed to the crisis, but they dismissed most of them as inconsequential or even as healthy behavior. They ignored weaknesses in accounting, in rating agency oversight. Let me go back, I have a lot there. They ignored weaknesses in mortgage underwriting practices until very late. They reduced bank capital requirements and encouraged banks to adopt model-based capital regulations that were easily gamed. They failed to regulate the bank's use of special purpose vehicles even after Enron failed because it hid its financial problems in special purpose vehicles. It allowed the SEC, an agency with no examination staff or experience, to be the safety and soundness regulator for the largest investment banks. It ignored the fact that subprime mortgages blew up finance companies in 1997 and again in 1999. It studied the use of bank securitization, CDS and CDOs, and put out an international report by the Financial Stability Board and concluded that these instruments were actually beneficial and made the banks safer. So there's a little bit of issue there with, you know, the regulator's ability to see the problems before they react. The other thing I would caution about is the scientific discovery process is far from perfect, and settled science often isn't. You might, all of us, if you're my age, you lived through the years since 1984 where the government told us not to eat our eggs, right? They were bad for you. So if you like fried eggs in the morning, you were damaging your health. But of course, this year they came out and said eggs are really okay, right? So the science changed over time. The professional academic journal process often leads to a bias. The journal only published positive results. There's been some new studies this fall in the area of medicine where they actually go back and they look at all studies that were commissioned for antidepressive drugs, how well they work. And they found out because many of these studies were commissioned, but only the studies that produced positive results were ever published. So there's this huge bias in the published literature in science where all the studies that they found didn't work actually never got published. And so if you actually look at all the studies together, it turns out they're not nearly as effective as people thought. And this bias permeates all the academic literature. It's very hard to get anything, trust me, anything published that you don't find some positive result. Economic theories, especially those for managing economic growth, had issues, and they had issues before the crisis. Keynes's theory was never complete. He never modeled the fact that governments have a budget constraint. The euro crisis is at heart a discovery that governments actually do have a budget constraint. Monetary policy before the crisis really depended on the Fed's changing rates influencing consumers' borrowing through refinancing mortgages, taking out auto loans. You know, once the consumer balance sheets were weakened by excess leverage, this transmission channel ceased to function. These kind of things were actually knowable, right, before the crisis. QE may have blunted the real effects of the financial crisis, but no one's quite sure how well it worked or how easily it can be reversed. So to summarize my comments, this is a great book for holiday reading. I really enjoyed it. It's got a lot of good stuff in it. It ties a lot of thoughts from different areas together, and we can see the phenomenons pretty much the same. Across a number of disciplines. The important phenomenon that many well-intentioned government policies, people adapt to those policies, and there are unintended consequences because of the way people adapt their behavior. In my opinion, it's a little too quick to trust science and economics, the models, as if they were actually settled. These guys are human. There's biases in the process, and I think we would do well to have a little bit more critical eye going forward. But thanks a lot, Greg. I very much enjoyed it.
Thank you, Paul. Frank.
That's great. Thanks. I wish I'd known. God, I wish I'd had that one thing. I have to put on my glasses. I'll tell you.
It worked. I'm astonished. So like Paul, I will sit up here so I can see the PowerPoint slides and not get lost. I want to thank Alex and AEI for hosting this event. I'm going to start off with the book. I think it's an excellent book. I admire Greg's clear, enviable prose style. I wish I had it. I'm reminded of what Ford said to D.H. Lawrence on Lawrence's second novel. It's a rotten work of genius. I really wish that I had written it. As Paul pointed out, this covers everything under the sun. Trains, planes, automobiles, germs, football helmets. Maybe not trains. I think in the next edition, perhaps you can cover trains.
Amtrak.
And the thing that I really like about the book, it's chock full of aha moments. There are all these things that you sort of intuit, all these things that you sort of thought about financial regulation in the financial system, but you never could quite put your finger on them. Greg sort of pulls them out and focuses your attention. But to me, the best part about the book is that it gives us another great literary rivalry. Shakespeare gave us the Montagues and the Capulets. History gives us Athens and Sparta. We've got the Dallas Cowboys and the National Football League franchise whose stadium is in Landover, Maryland, whose name I cannot say. And to this list, we add the engineers and the ecologists. To me, this is the really brilliant innovation that Greg has come up with. These two are almost Weberian ideal types. They approach the world in different ways. They see the world differently. The engineers see the world as a series of problems to be solved. The ecologists see the world as a set of solutions leading to ever more problems. And now that Greg's identified these two, I see them everywhere. I see them in myself. My wife is the parent. I'm the ecologist. Let the kids do whatever they want. They'll learn from their mistakes. My wife is the engineer. Let's foolproof the house and make sure that they're safe at all costs. But I'm not here to talk about my parenting skills or lack thereof. My interest has been, continues to be, and probably always will be financial regulation until I can afford therapy. What do the engineer and the ecologist have to tell us about financial regulation? Quite a bit, but let's step back a bit. Sort of get to first principles. Why is financial regulation so hard? Greg pointed out that crises seem to be inevitable. No matter what we do, no matter how we set it up, we always seem to keep coming back to a financial crisis that causes us to explain, what happened and to do something in response. And I think the reason it's so hard is that there are three things we want from financial regulation. The first is we want growth. We want credit formation, we want capital accumulation, we want a vibrant, innovative economy that perpetually grows. The second thing we want is stability. We're not particularly fond of recessions, and we will do anything to avoid a depression. And the last thing we want is we hate bailouts. The people that I used to work for hated bailouts. They would much rather have seen the financial system collapse, capitalism fail, than to vote for a bailout. And it's no reason. Bailouts are unfair, and they engender moral hazard. There's just one small problem. We're only going to get two of these things at a time. And I made this neat little chart. This is my contribution. This is my pet theory of financial regulation and financial crisis. After this, I'm done. I can retire. What I've done, though, is I've added the engineer and the ecologist to this. So if we want no bailouts and we want financial innovation and credit creation, we can go the Andrew Mellon route. We can let the system run as quickly as it can, but if it fails, it fails. We will purge the rot from the system. The other thing we can do is if we want financial innovation and credit creation, but we want stability, we can set up a system of bailouts. We can have the lender of last resort. We can have 13.3. We can have TARP. We can have all of the wonderful facilities the Fed created during the last financial crisis to keep us going. Or we can have the no bailouts, and we can have financial stability, but we're going to give up a little bit on financial innovation and credit creation. And there's this wonderful paragraph in Foolproof where Greg makes this point. He talks about we could go back to the quiet period, but nobody liked it. Nobody liked it because there was gains to be realized from letting the system loose. So when I was on the Hill, I stumbled across a quote from Martin Wolf, and I thought this was the most brilliant thing I had ever read. In this, Martin Wolf is acting as the ecologist. Suppose there were no lenders of last resort, no government deposit insurance, no government regulation of financial intermediaries, and no bailouts. In fact, I think this is the world that Paul's describing, or maybe not. Would the world be more or less dangerous than it is? Martin Wolf says, the answer is not at all obvious. Or is Martin Wolf acting as an engineer? What is certain is that without the prospect of any intervention, the financial system would look quite different. Banks would be better capitalized. The point that Greg makes in his book, maybe capital is the answer. Maturity mismatches would be reduced with greater reliance on securities. Deposits would be matched by highly liquid securities. In other words, the system would look a lot different. It would be a lot safer. Does this resolve the trilemma? Given the frequency of banking crises, this might be a big improvement. Now, I so love this quote that I shared it with a really good friend of mine, somebody that is far smarter than I am, somebody who really understands financial regulation, somebody that I admire and look up to as a hero. Now, I love the quote because it's almost algebraic in its simplicity. You figure out what you want and you solve for it. If you're serious about ending bailouts, you solve the problems that lead to fragility. If you solve the problems that lead to fragility, you'll end bailouts. Is there something for everyone here? Ecologists are willing to cut the safety net in all its forms. Engineers are looking for a better regulated, safer financial system. Well, something for everyone, maybe not everyone. As a friend of mine pointed out, in this state of the world, credit will be more expensive, there will be less of it, and asset prices will be much lower. In short, we will all be poorer. So that's what financial regulation is up against. That's the reason that it's so difficult. That's the reason that we have both engineers and ecologists. Everybody hates a particular part of that triangle. Nobody is really quite sure how to put them together. Greg offered us a bit of a solution, or at least a way out. He came up with this idea of space. If there's more space in the system, there's more room for error, there's more room for accidents to happen, the system is less at risk. And he came up with capital, and I want to be clear at the outset, I agree with Greg 100% on this. The banks need to be better capitalized. I know that some improvements have been made. I think that even more improvements need to be made, but I want to step back a bit and play devil's advocate a bit here, or beer here. So the first question is, well, capital is an answer, but is it too good an answer? Does it give us too much safety? Charles A.E. Goodhart, who is a brilliant economist, an expert on financial regulation, and all-around smart guy, as you can tell because he has two middle names, asks us, well, why haven't we solved the problem of financial regulation? Why are banks still unsafe? Is it because we're idiots? And he says, no, the problem is that there is a cost to regulation. If you make the bank safe, the price of credit is going to go up. Bank lending will continue to contract. A credit-less recovery becomes more likely. Well, everybody gets the point that if you have more regulation, then the cost of credit may go up, may not. Nobody's really quite sure where to draw the line. But to me, the really interesting part is that it's possible that capital may give us too little safety. One of my favorite quotes is from Walter Bagehot, and he makes the point, a well-run bank needs no capital. And in fact, if you go back to Greg's book, he has this really appalling interview with Walt Wriston, or not Walt Wriston. Remind me, Greg, who was the Citigroup CEO?
Walter Wriston.
Walt Wriston, I got it right. Walt Wriston is talking to Paul Volcker and says that I don't need capital to run Citibank. That's something that the old fogies require for me. Well, it turns out if your bank is well run, you don't need any capital. Problem is that if you're a badly run bank, you're going to need lots of capital. And if you're a really badly run bank, no amount of capital is going to make you safe. So that brings to mind this famous quote by Warren Buffett, who says that he only buys stock in businesses that are so wonderful that that an idiot could run them, because sooner or later, one of them will. Well, maybe that's not a bad way to approach bank regulation, knowing that one of these too-big-to-fail banks, one of these SIFIs, as Paul pointed out, at some point will be run by an idiot. So maybe you want to make it as safe as possible. I'm really not quite sure what the answer is, but I think it's an issue that's well worth thinking about and that continues to keep me awake at night. So I'm going to skip all of this because it's way too long and get to the end, which is my favorite story, the central banker's prayer. Had I known that Paul was going to put all these wonderful pictures in his presentation, I would have put even more, but I'll give you one. There's this guy who is these days, not unemployed still, but doing something different. He had this lunch with the Financial Times, lunch with Martin Wolf of all people. And Ben Bernanke made the same point that Greg makes in his book, that you want crises in the system, that without crises there is no growth. And he draws this wonderful analogy. If you never miss a plane, you're spending too much time in the airports. Well, I think that's true, but there is this problem. If the price you pay for missing the plane is spending a year as a guest of Iranian student revolutionaries, maybe it's worth killing an hour or two browsing duty-free. And if the cost of missing the plane is spending another night at your in-laws, maybe it's worth turning up at the airport a day early. So for the most part, the costs of missing a plane are manageable. On the other hand, the costs of a financial crisis are crippling. Better Markets, the institution that I'm proudly a part of, has put out a report that estimates the cost of the financial crisis at $20 trillion. That's a figure that's so big, I can't come up with a way to convey to you just how catastrophic that was. In terms of weighing the cost of financial regulation against the benefits, the financial crisis has got to be the most expensive cost-benefit analysis conducted in the history of the world. Is that my minute? Okay, so let me wrap this up. And Ben Bernanke gets that in the interview. he keeps talking to Martin Wolf, and Ben Bernanke says, in light of the economic performance of the 50s and 60s, the repressed period that Greg Epp identified, the one that we're all trying to get away from, you can't rule out the possibility that a more repressed financial system would give you a better trade-off of safety and dynamism. And that's the difficulty, getting the trade-off right. Ecologists are concerned about the micro-level risk. The system benefits from small-scale disasters. Engineers are concerned about the macro risk, preventing large-scale catastrophes. Problem is that we can't tell what is a small-scale disaster and what is an existential threat. So that gives us the central banker's prayer, in which the central banker asks for the courage to rescue a bank whose failure would bring down the financial system, the serenity to accept the failure of a bank whose failure would not, and the wisdom to know the difference. The problem is, I don't think any one of us will ever know what the difference is or how we know that we know it. So with that, thank you, Greg. It's a great book. Great book. Thank you.
Thank you. Thank you, Frank. Ladies and gentlemen, I think you heard three really terrific presentations, both in their power to instruct and their power to delight and entertain. However, I want to, while Greg is thinking what he wants to say in comments on the comments, I want to object to the idea that the problem is a bank run by an idiot and pose, Frank, for you another contrast. We have engineers and ecologists, or Montagues and Capulets. But Hyman Minsky told me the problem was the difference between entrepreneurs and bankers. And he said the whole financial world depends on the right balance between entrepreneurs and bankers. Growth depends on entrepreneurs. Entrepreneurs are optimistic, very warm, superbly self-confident, able to leap high buildings in a single bound, and they actually do it, or at least they go through the walls, and they build great things and do great creation. Of course, they also very often fail, and their companies crash, but that's the entrepreneur. Bankers, said Hy to me over this memorable lunch, are the opposite in every way. They should be cold, skeptical, if not cynical, always looking on the downside, always thinking about the risks, always trying to create space or margin. He didn't say that, but it fits. And so you have to have this balance between the optimistic, warm, I can do anything entrepreneurs, and the skeptical, what about the risks? No, we have to protect ourselves, bankers. And of course, the problem comes when the bank is taken over by the entrepreneur, who may be utterly brilliant, nothing at all like an idiot. And part of the implications of Greg's story is in all parts of the system, central banks, regulators, managers, investors, borrowers, you can have utterly brilliant people who nonetheless make utterly disastrous mistakes. With that little addendum, Greg, any comments you'd like to make or reactions to the discussants?
First of all, it was terrific listening to your comments. My only regret is I didn't sit down and get these out of you before I wrote the book, because so much of them would have had a great home in the book. Some of these observations, I really, really appreciate them. So a couple thoughts in responding to a few points Paul made. There was so much there, I can only touch on a few things. But you cited some of these historic failures that did not teach regulators a lesson. And you mentioned, for example, subprime 97, 98. And I wrote about that at the time. And I think, ironically, many of these regulatory failures that occurred during the Great Moderation had the perverse effect of telling the regulators that actually the system was quite resilient to these little pockets of failure. The subprime meltdown of the late 90s, which often involved, for example, mobile homes, told them that, well, we knew that these had a high default risk, but look, and we had the defaults, and there was a lot of wreckage, and a lot of these companies failed, but it didn't have broader systemic consequences. So there was a consumer protection argument in favor of regulating subprime, but there wasn't really a systematic or a systemic prudential argument in favor of regulating subprime. And I do believe that, in fact, there's a narrative that predatory lending caused the subprime problem, and it's certainly the case that there was some predatory lending going on, which I would myself define as loans that were made with excessive fees that did absolutely nothing for the borrower. But there was a lot of non-predatory lending going on where eyes were wide open by both the borrower and the lender. And so I think that what you had was a lot of these things were sort of like seen as testing events, and that the system's ability to respond to them reinforced the presumption that you did not have to worry about them. You made, I thought, this very interesting comment about whether we should trust in research, and I guess I trust in research because I don't know what else to trust in, and I'd rather have some than not, and I worry very much about the points you just made. So I guess what I would say to that is, well, what's the alternative to make rules without any research at all? And I'd also be curious as to whether you think that the research flaws that you've detected have a directional bias, whether they tend to find in favor of particular directions. So I would say this might explain why a lot of the engineering studies of safety innovations or things like energy efficiency tend to find much greater benefits than field studies do after the fact, and maybe that's what's going on. Turning to a few of the comments that Frank made, he touched on a lot about the trilemma of financial regulation and systems that evolve with or without these things. One of the things I'm struck by is that a lot of the things that lend fragility to the financial system or create moral hazard, whether it's things like the fractional reserve banking system, actually predate central banks or regulation. A lot of the things that create the fragility in our financial system grew up in an environment where there was really no government intervention. So it tells me that there is something endogenous to the capitalist or the market-driven system, so that even if we did take all these distortions out, we'd probably still end up with crises. But for the same reason, I know there are people out there who advocate things like narrow banking or 100% reserve banking. In other words, don't let banks invest their deposits in anything except cash. But I also don't buy that argument either, because again, fractional reserve banking, where banks would both have deposits and loans, grew up in an endogenous kind of organic way. So I believe that they are fundamentally doing some good. I recall one study that found that in 19th century America, towns that had a bank grew faster than towns that didn't have a bank. And this was, I'm sure they probably also had more runs on banks for the same reason. But I'm sure at the end of the century, those towns were better off for having both banks and runs on banks. I think you wanted, and then there's a historical question in my mind, and actually, Alex, you can perhaps answer this. This question occurred to me as I was studying the quiet period, 50s and the 60s, and Bernanke has brought this up. Well, a lot of people who are in favor of tighter regulation believe that they look to the 50s and the 60s and they say, well, here was a period where we had a very repressed financial system, and it was a great period for the economy with rapid growth and high living standards and so on. Why can't we go back to that? There's a part of me that believes that that actually was not a sustainable equilibrium. In fact, the research I did on this book told me that, for example, the money market mutual funds, which played a role in the financial crisis, grew up as a response to the repression that forbade banks from paying above a certain rate on deposits. So I'm actually not sure that going back to that world of the 50s and 60s is a viable alternative, because with the benefit of hindsight, we can say that perhaps it wasn't sustainable. I'd actually like Alex's and some of the others' opinion on that, because I think you know the history better than I do. And the final point I'll make is about the Minsky observation that entrepreneurs and bankers should be different people, and it's a terrible thing when entrepreneurs become bankers. I'm not so sure about that. In fact, one of the reasons the U.S. had a financial crisis was because we had a more diverse financial system. Our banks were smaller and less important, and that was perhaps not consciously a choice to allow non-banks like shadow banks to thrive and see whether they could do some things that banks didn't do. And I think that the U.S. financial system is unbelievably diverse. Walter Bagehot used to argue that the reason Britain achieved industrial supremacy over France was that any entrepreneur in Great Britain could find somebody who would lend him the money to start that venture up. And so he used to say, it is this, feature of capitalism, it is the presence of the money market in London that makes us great. But he went on to say that money cannot manage itself, and that's why he was in favor of a lender of last resort. So I believe that entrepreneurial banking is actually, in the end, a good thing, even if it does require a close eye in the periodic period of upset.
Thank you very much. Paul and Frank, you get 2 minutes each for any additional comments.
Yeah, one of the things that I think people did not learn in the 1997 and 1999 subprime crisis was the fragility of some of these they were special purpose vehicles as well. The facility the trust that includes the mortgage-backed securities. And what had happened that caused the firms to go bankrupt was the firms couldn't sell the residual pieces. And they had used very optimistic accounting for the residual pieces, which turned out to be pretty bogus. And that's what ultimately brought the finance companies down. But I was in a bank regulator for all the years after that, and that really never hit bank regulators because it happened in the finance company world where bank regulators weren't paying any attention. So you're right. If it would have caused a crisis, somebody would have paid attention to it. But it wasn't like we couldn't learn the lesson because, a couple of years later, Enron goes bankrupt because it's parking all kinds of things in special purpose vehicles. So you would think that special purpose vehicles would be like a bright light. But what happened was as the 2000s progressed and as the feds set regulation on this, they totally exempted special purpose vehicles from a lot of their regulations. They didn't know how to treat them. So actually, when the Fed put out 23A rules in response to a law, they had to put it out because of Graham Leach Bliley. They specifically said we're not going to, and if a bank were to have a line of credit with a special purpose vehicle, they were excluded from 23A restrictions because the Fed said, well, the accountants haven't quite figured out how to treat special purpose vehicles, so we're not going to rule on this. But they never changed the ruling all the way to 2008. And so in fact, banks could extend all kinds of lines of credit to CDOs and all kinds of things that were part of the holding company, and they weren't subject to any of the regulatory limits. And the regulators considered it. I have a paper I'm happy to share with you on that. So it was right under their nose, and it was happening all around them, and they didn't see it. When it comes to the research bias, I'm sorry. Frank.
Give us 30 seconds on research bias.
I think all the sciences have a sort of a bandwagon effect. Whatever the newest, greatest, everybody wants to contribute to it, and it's really hard to get a paper that says, well, wait a minute, that's not quite right, especially when the big names in the field have put something out. So it's not exactly a level playing field where every paper and every result gets the same sort of weight, in my opinion.
Frank.
So let me start with Alex's observation, or Minsky's observation about entrepreneurs and bankers. And to me, this is incredibly fascinating because it gets to the idea of space. In a prudently run bank, there is this idea that a prudent banker is going to walk away from some money on the table. The entrepreneur never would be. And probably, and I think it's regrettable, but the most pilloried statement from the financial crisis is Chuck Prince's, as long as liquidity is there, you have to get up and dance. And I think what you're looking for is somebody to sort of say, no, you don't have to dance. You can walk away from the last croissant on the table. If you're Mr. Creosote, if you're a Monty Python fan, you don't have to have the last wafer-thin mint. You can avoid catastrophe that way. But it's interesting, and what I would say is that it's not entrepreneur and banker so much as it is ego and superego. You need somebody that is there, the adult, to sort of say these are the limits. Unfortunately, that's probably not going to come from the bank itself. The bank itself, if it's a profit-seeking organization, which I hope it is, will have every interest in making the last available loan that it possibly can and obtaining as much as it can in the way of funding, which makes it incredibly unstable, given that it's going to be difficult within the bank to find somebody to play the part of superego. That doesn't leave us with a whole lot of choice to turn to the regulators. And like Paul, and I believe it or not, Paul and I think are closer on this than would appear from the presentations we gave. I am incredibly suspicious of the regulators. I think that's the most important lesson that we can come up with from the financial crisis, is that everybody should be skeptical of everyone else, and everyone should be skeptical of himself. The problem is that I don't see an alternative to the regulators. And I think if I've got one criticism of the ecologists, and in case it's not obvious, I identify with the engineers, it's that the ecologists, if you follow their logic to its conclusion, are just incredibly pessimistic. There is no solution. Everything we do will end up causing even more trouble than the problem we tried to solve, which leaves you feeling just incredibly helpless. If that is the case, why do we do anything at all? And I have to say that the last time that it's funny that Alex mentioned the philosophy bent. I never really thought of myself much as a philosopher. The last time that I encountered that level of pessimism, it was in the later varieties of Western Marxism, where people had realized that no, the revolution was not coming. Capitalism was here to stay. Let's just sit around and mope about it. I think we can do better than that. I think that's the essence of capitalism. That's the vibrancy. So yes, I believe in regulation, but I'm also optimistic about it. And ultimately, what choice do we have? What are the alternatives?
Thank you, Frank. I'm going to take a minute or so to answer Greg's very, very important question about the 50s and 60s, and then we're going to have a brief period of audience Q&A. I think it's absolutely right that the 1950s and 60s were a non-sustainable special period. The 1950s in particular were a completely non-repeatable period caused by World War II. The United States came out of World War II astride the world and a colossus in every way, politically, militarily, economically, and financially. And so the American financial system benefited from that, from the American hegemony of the world, which was bound not to last as the rest of the world recovered from the war. And by the 1960s, it was already not lasting. The 1960s were not financially calm. There were a whole series of dollar crises as the Bretton Woods system piece by piece fell apart, ending in 1971 by the repudiation of its international obligation to pay in gold by the United States. There were very severe credit crunches in which mortgage credit disappeared from the American economy in the 1960s. And we were coming to the then, of course, tumultuous great inflation period of the 1970s. I think it's what we have lived for in more recent times, I think is much more to be thought of as the normal situation than the extremely abnormal situation of the United States, especially in the 1950s, because of the outcome of the or because of the outcome of the war and the nature of the post-war world. Well, there's one possible perspective on it anyway. Ladies and gentlemen, if you have a few questions, we'll take them. We'll start here and then here. Yes, can wait for the mic. Hang on, let me remind you of the rules. You have to wait for the microphone, tell us your name, your affiliation, and ask your question, making sure it's a question. Come ahead. Right here, please, Ryan. Thank you.
Yes, I'm Per Kurowski, Voice and Noise Foundation. I used to be executive director of the World Bank while Basel II was being discussed. I come from a developing country where I see the Indians and small agriculture always burning a little bit in order to stop a lot of material accumulating, because that if it burns with a lot of material, then it scorched the earth. So for me, the whole thing of keeping away a financial crisis was going the wrong direction. But I wanted to make just a brief question about research. Because when you are a regulator on bank, you should be researching why banks fail. And they were really researching only why bank clients fail, which is not the same thing. They put up a system of capital requirements for banks based on the credit risk of the clients, and not based on the possibility and the risk of the banks not being able to manage those risks, which is completely different thing. So they introduced a distortion.
I've got to make you come to your question, please.
Yes, they introduced distortion that means that nowadays banks earn higher returns on equity when lending to the safe than when lending to the risky. And that comes from the little fact that there was never, ever a word about the purpose of the banks. So I just want to ask you, what is the purpose of our banks? And if we define that purpose, can we defend the current regulations that distorts completely the allocation of bank credit?
Thank you. What's the purpose of banks? Anybody want to take this on?
Well, I guess
We'll let the author speak.
I guess I have a different point of view than you, because if you're trying to focus on what the bank does, I mean, in fact, Basel II focused heavily on internal risk management systems. And here in the United States, the implementation, Frank and Paul, you would know this better than I, focused on not so much telling the banks how to run themselves, but making sure that they actually had a system for running themselves. And I think what we learned was that banks often don't know how to run themselves. And in fact, one of the conclusions I came to in writing my book was how often these, like anti-lock brakes, it turns out that when these risk management devices such as a hedge are put in practice, they don't work the way they're supposed to. And I think, for example, the London whale trader who blew a $6 billion hole in JP Morgan's balance sheet is an example of that. And that's why I think actually capital is a better idea, because capital is somewhat agnostic to why you blew a hole in your balance sheet. It could be a rogue trader, it could be a bad credit or something like that. I kind of that's what I like about capital, because I think that I don't want to gloss over how difficult it is to do because there's risk weightings and so on. But generally speaking, a bank that has lots and lots of capital can have almost any kind of risk management failure and not fail.
No, and I'm sorry. No, we can. But afterwards, we'll have an informal session. We can have the talk. I have another question here, please. Here.
David Brazil. I like the ecology analogy, particularly because ecology focuses on the survival of the species, not the individual, and which I take in this context could imply that by putting too much focus on trying to save every individual out there, we cause more problems than we solve. And in fact, so what we need, what is good is a certain amount of volatility in the banking system, in the economy, which we try and stifle for some reason. And I guess I'm really directing my comment to Alex because of his comment up here about why we are poor, because we went too far on the ecology side.
Was that Frank? That wasn't me. My comment was that
it was
quoting Greg, that the same thing
Or I
that
might have
creates
misunderstood your comment.
creativity
Frank quoting you, Alex.
and wealth creates risk and therefore crisis. Frank, you have a comment?
Actually, that was me quoting Alex after this really great Martin Wolf quote.
A game of telephone here, I guess.
In Alex's defense, that quotation comes from about 4 years ago, so he probably doesn't remember it. But I think there's a lot to be said for your point. The great thing about ecologists is they focus on survival of the species rather than individuals, and the difficulty are those circumstances in which the survival of the individual may determine the survival of the species. And I hate to say it, but that seems to be the conundrum that's at the heart of the too big to fail problem. If you are in a position where you have to ensure the survival of a particular individual, a particular large financial institution, a particularly large bank, then the ecologist's choice of letting the individual go to save the species isn't a choice anymore. The difficulty is that you'll never know. And one of my favorite parts of Greg's book was where he was talking about trying to draw the lessons from Lehman and the lessons from Bear, and there are all sorts of ways to play it. There are people that say, well, Lehman was so important. To let it fail was just a tremendous gross mismanagement of central banking powers, and Lehman should have been saved. My friend Peter Wallison tells me, no, the mistake was saving Bear, because that sent this lesson to everybody that Lehman, of course, would be saved. And the funny thing is that I don't really know the answer. Taking Paul's point about the science, if I could, I would run this experiment a dozen different ways. Lehman's saved, Lehman fails, Bear saved, Bear fails, just to see what would happen. And the great thing about this is we'll never know.
I think you're absolutely right about that. We're a little bit over time, but I want to call the audience's attention to one really fascinating thing in the book, which Greg discusses, which is the role, as he mentioned, of AIG and the credit default swaps, which were you might think of as credit insurance policies, but it would be misleading because he cites a study that shows in the long run, at least on the AAA tranches, which is what AIG guaranteed, there were virtually no real credit losses in the end, right?
Yeah, on the MBSs, on the CDOs, there were losses.
On the MBSs.
On the CDOs, there were losses.
Yeah. But they went broke anyway because what they were really guaranteeing was the price of the MBS, not the ultimate loss, which is a fundamentally different risk proposition. Anyway, I think as you will tell from this discussion, this is a very provocative, interesting book. Thank you all for being with us, and let's appreciate our author and our discussants for a great session together.
We'll be around to chat afterwards if anybody wants.
And you're all invited to join us next door. We'll talk more and get Greg to sign your books.